Hello everybody, welcome to the channel. Hopefully you had an amazing day yesterday and a great start to your week. Today's video we will be breaking down Lululemon's earnings report and conference call. Hopefully, I'm not sure if Lululemon is in your portfolio. It certainly is in our portfolio, the Like a Tortoise portfolio. And so I want to make everything clearer for you. As always, if you find this video insightful, please make sure you smash the like button because it really helps the channel to grow. And once again, thank you so much for everything that you have been doing for us. And that includes passing the word and also many of you have become clients, so I definitely like that, of course, but that means that you are gaining a lot of value from these videos as well, which makes my days. Right, so let's discuss everything that you need to know. In simple terms, just speaking in terms of price action, the stock is practically unchanged, so it's down about 2%, which is nothing considering the volatility that we've seen across some of our holdings. But yeah, so the report by and large was not outstanding by any means, but it was not it wasn't horrible. Okay, in fact, in many cases, I think it was in line with expectations, which were already a bit. It was already a bit down, right, in the lead up to this earnings report. So let me start by sharing. Let me just minimize this. And now, as always, I put everything in a document for you guys to see. This makes our days much easier, right? This is where I keep everything. It took me a while to put this together, as it normally does, but hopefully you guys will find it insightful. All right, everybody. So despite short-term pressure, I remain constructive on Lulu. The company, in my opinion, is taking deliberate steps to restore its premium positioning and improve execution. Some of the things, I'm not sure if you guys tune into the conference call, but I was actually surprised by some of the things they said, but we will discuss that as well. So they are taking deliberate steps to restore its premium positioning and improve execution. These changes may weigh on near-term results, but should strengthen the business over time. So I will break this down as we move along. Headline summary: beat on earnings and revenue. So this was not, this was bullish, right? So the matter of fact is that analysts, again, had already lowered the expectations. As you can see, expectations had been lowered by analysts, so they were already concerned. And so that made it allowed the company to actually deliver a beat on both the top and bottom line. But the main culprit for the slight decline in the price, in my opinion, was the fact that guidance disappointed on both revenue and earnings per share. So the stock, as you can see, slipped 2% pre-market. This was a beat the quarter, miss the future type of reporting. Markets are reacting to the forward outlook. Let's talk about revenue performance. And as always, as expected, the Americas region continues to meet the main drag. As you can see, revenue actually was flat year over year. So it was about 3.6% billion reported. They actually grew comparable sales globally, right? So it was up about 3%. Growth remains modest with clear regional divergence. So the main drag right here, the reason comparable sales didn't grow greater was definitely because of Americas. You can see that in the Americas region, which is the core market, okay, you can see that the Americas is about 74% of total revenue. True, this was down from 77% in year over year. However, it's still a major contributor to overall revenues. And that's why, even though the company, as you can see, is growing very attractively internationally, that really won't move the needle for the company over the short and even medium term. They need to turn the Americas business around to make a dent, a positive dent in, okay? Otherwise, I mean, the business will remain sluggish. And that's what we are seeing right now. Because as you can see, so in the America, comparable sales declined 1%, revenue declined 4% year over year. But look what happened internationally. The core market is declining, but internationally in China, revenue was up 24% year over year. Comparable sales a staggering 30%. That's now 15% of total revenue, which is up from 12%. This is good and expected. Rest of the world, comparable sales up 9% and revenue was up 10% year over year. Despite this great growth, the overall revenues remained flat year over year and comparable sales only grew 3% globally, exactly because they decline in the Americas, which is quite frustrating to see. But again, it's not unsurprising. Gross margin compression, this is another thing that we have to highlight. Gross margin was down to 54.9%. This was down from 60.4%, right, compared to last quarter. In fact, compared to quarter 4 2020, quarter 4 2025. Okay, so let me show you exactly what that means. If I go here, so we are already in stock analysis. Look what that means. Let's go right here to the quarterly where we are, and now you can see gross margins right here. All right, so if you compare that in quarter 4 2024, we were at right here 60.42%, and now we are at 54.87%, which marks a significant decline. And this is on the back of the tariff headwinds and all the other things that we are about to discuss. So look at that. Tariffs impact 560 basis points, increased markdowns, higher costs, occupancy, and FX impacts. Let's discuss now operating in performance, which also slipped. Look at that. Operating income was 812 million, down from 1.1 billion. Operating margin 23.3%, down from 28.9%. Right? You can see that again. If we go right here to operating income, take a look at this. Right? This is February 2, 2025. There was a decline from about 1 billion to 812 million. And what you can see contributing to this decline is look at the selling, general, and administrative expenses. So operating income declined not just because revenue remained flat, but also because operating costs accelerated. That's not a great mix, is it? So we are seeing flat revenues, but we are seeing increased operating expenses, and this all contributes to those to that margin pressure that we are witnessing. Go back right here. Net income, as you can see, was 586 million. Earnings per share was about 5 versus 6.14 prior year. Key takeaways: revenue is stable, but profitability is declining. Yes, classic margin compression. Let's have a look at margins or the margins right here. So we discussed operating margin as well under pressure, as you can see, and same goes for profit margin. Okay. All right, let's move on. Cost pressures, tariffs. Tariffs remain a major drag. Expected gross tariff impact 380 million versus 275 million prior year. Net impact after mitigation 220 million. So Lululemon has been, as you guys know, negotiating with suppliers, avoiding price increases, using promotions to support demand. This was the case up until now. This limits pricing power in the short term. Then we saw some additional cost pressures, right? Marketing spend increasing, as I already alluded to, labor and incentives rising, proxy contest costs with Chip Wilson, which is the founder and former CEO. What does that mean? As you guys know, for the last several months, they have engaged in this proxy battle with Chip Wilson, because Chip Wilson is not happy with what the board has been doing. In fact, he is even calling for some of its members to stepping down as a result of the lackluster performance. But he says that all the issues Lululemon is facing are fixable, which is bullish in my opinion. And I think the board is also taking steps to ensure that to appease, right, to ease these any sort of confrontation with the founder, and they are, because for example they have appointed a new board member, and among other things that we will be discussing. Okay, I don't want to spoil things right now. Balance sheet, and in terms of balance sheet and capital allocation, this is something that jumps out at me. Inventory grew 18% year over year. Let me show you where to look for that. Let's go here. That's stock analysis. Look at that. Let's go to inventory right here. And you can see that inventory was about 1.7 billion. So it has increased from 1.4 billion in quarter 4 2024. This means inventory jumped. Where is the PDF? Okay, so right here, this is the PDF. Important signal. Inventory is growing faster than demand. This suggests execution and demand mismatch. And I think, where do I want to... I'm not sure that I have that here. Something that I left out. So let me just do the math for you guys here. Okay, so look at this. Right here, we have quarter 4 inventory. So, yes. Let me see where this is. Where is that? I wanted to do something right here. So how much of a percentage? This is what you guys have to do. A key yellow flag in the balance sheets is when inventories are growing and net income has been declining. And the quick math that I did right here is that inventories have increased, as you can see, right? When you compare quarter 4 2024 to quarter 4 2025. However, during that same period, if you go here to the income statement and go to the quarterly tab, you can see that net income during that same time declined substantially from 748 to 586. And that, ladies and gentlemen, is not what we want to see going forward, okay? Because this means that they are having a harder time getting rid of the new inventory, and they probably have to resort to markdowns going into the future, right? Which is not good because it will further depress margins. Right, let's go back here. Share buybacks. So they continue to do share buybacks, which is constructive. In fact, we can see that the share count has been declining as well. Look at that. Okay, on a quarterly basis, this is good. They recognize the stock is cheap. Share count declining, capex lower year over year, indicating more disciplined spending. In fact, during the conference call, the interim CEO Megan alluded to this. They alluded that they remain more vigilant now than ever. They have always been cautious about the way they were allocating capital. But now, because the North America sales, which is the major market, is sluggish, and actually not sluggish, declining, right? They have to be more attentive. And if I show you CapEx right here, look at capital expenditures growth. So they have it's significantly lower compared to quarter 4 2025, exactly because of the headwinds they are facing. So they want to continue to spend to grow the business, right? They have to open new stores. And in fact, they open new stores even in the Americas. If I go right here, I can show you that. Let me show you that. The store count is right here. This is the report presentation. Okay, you can see that the store count has increased. Look, where is that? Let's see. Not the share count. Store count. Here we go. Look at that. New company operated stores. We opened 7 new stores in China mainland, 6 new stores in the Americas. So even though sales are declining in the Americas, they are still opening new stores. That, to some extent, of course, contributes to revenue growth as well. So we will really want to understand the numbers and look under the hood, because when you open new stores, that will contribute to revenues. And that's why we want to see comparable sales. Are they declining or increasing? But they are still opening. So, of course, this means that inventory should grow. But ideally, profitability should increase alongside, and we are not seeing that. Okay. Management is implementing a 3-pillar turnaround plan, as you guys know, and they discussed this during the conference call. That includes product creation, product activation, and enterprise enablement. What does product creation means? This was one of the issues why sales in America have declined and why they allowed competition to catch up to them, because they forgot to they stopped innovating, they stopped engaging with customers. They mentioned that. And so as part of the product creation pillar, they are focusing on improving innovation and speeding to market, in speed to market. So they want lower product cycle times. All right, they want to release new product lines faster, right, to respond to the customer's needs. They are focusing on quality and consistency, better product coordination as well. For example, color palette. And I saw that because myself and my girlfriend, we visited one of their stores not long ago, and the color palette has definitely changed. And I think customers are responding favorably to those changes. Addressing recent product missteps. As part of product activation, they are increasing brand engagement, attract new customers, strengthen marketing effectiveness. And as part of the enterprise enablement, again, they are tightening the costs and improving operational efficiencies across the business. And this includes as well something that the interim CEOs addressed, building AI, integrating AI across the business to make it more efficient as well. Strategic shifts, return to premium positioning. This is something that actually caught me off guard. I found it very interesting. So initially, as you guys know, Lululemon, in order to get rid of some of the inventory buildups, they were doing some markdowns. In other words, they were decreasing the price of their products in order to sell them, which was part of the reason why margins were a bit under pressure. Right now, they are completely changing that. This is completely different. So Lululemon is actually, they will prioritize reducing markdowns, focusing on full price selling, rebuilding its premium brand image. The key insight here, this will likely hurt short-term revenue, but should improve margins, strengthen brand equity long-term. And what's fascinating is that, and again, it's a testament to the brand positioning. They can afford to do price increases. They have done that in the past, and that didn't stop customers from buying their products, which goes to show how how strong their pricing power really is. Now, there is only so much price increases you can do before pissing off your customers. Especially, as you guys know, the company has faced some criticism recently because due to the quality of their innovations. So, for example, some of their leggings you can actually see through these fabrics, and that's not good, is it? Especially when you are paying a higher premium for the products, you want them to have quality. So it's a fine line they are walking between guaranteeing that quality, but at the same time guaranteeing that the products are released fast enough to respond to the customer's needs and preferences. Guidance, reason for market reaction. Quarter one revenue was this. This is below expectations. Same thing with earnings per share. The full year guidance, again, below expectations. Market concern equals slower growth plus margin pressure continues. All right. So what about management and governance developments? Added format. This is a big change. So they are now adding Levi Strauss, former CEO, Chip Berg, to the board. In addition, ongoing pressure from founder Chip Wilson. Mixed signal. Governance tension exists, but new board experience could strengthen execution. And one thing that I want to say as well, very important, is that while none of the boards suggest, so Chip Wilson had suggested, if I'm not mistaken, three. He had put forward three board members. He had put forward three potential board members. While none of them has been selected for the board, the reality is that Let me go back right here because this is important. It's an article that you can see on CNBC. Let me read that out to you. As part of the announcement, in fact, let me start from here. Just before releasing earnings, Lululemon announced it was adding former Levi-Strauss CEO Chip Bergh to its board of directors. Bergh was not among the candidates Wilson put forward for consideration, but he does have considerable public company experience and spent around 13 years as Levi's CEO. During his tenure with the company, Levy began pursuing a more profitable direct selling strategy and sales rose by around 30%. So this guy has a nice track record of creating a lot of value. It's nice to see him on the board. And also, and this is what I wanted to read to you because this is important, even though none of the founders, Chip Wilson, board members has been appointed, Lululemon said board member David Musafir, managing partner and chairman of private equity firm, will not stand for re-election during the company's upcoming 2026 shareholder meeting at the conclusion of his current 3-year term. The announcement marks a win for Chip Wilson, the company's founder, who has criticized Musafir publicly. In a letter to shareholders last month, Wilson pointed out that Musafir was overseeing the board's interview process for prospective nominees at a time when he was up for election, creating a potential conflict of interest. A source familiar with the matter said Wilson had called on Musafir to step down from the board because he lacks independent leadership, among other issues. Okay, this is very good for the company long term. And again, it goes back to the point that I was making, that in my opinion, and based on what I'm reading right here, the board wants to stop this war with its former CEO and founder Chip Wilson, and I think this is very constructive. Okay, certainly steps in that direction. Okay, what else? So key issues to monitor. Again, they remain the same. America's turnaround, right? Margin recovery, especially gross margins, inventory normalization, effectiveness of premium repositioning. How effective is that? We want to see that. Continued strength in America. But the most important aspects will be margin recovery and America's turnaround. All right. Final take, my opinion as well. This was not a clean quarter. Core market is weak, as we know. And I was expecting that to be the case as well, even though I wanted to see if the customers were responding favorably to the new product lines that they were going to release. And according to the interim CEOs, that appears to be the case, which is why I continued. So, which is why I'm constructive on the company going forward. Okay. However, international growth remains strong. Brand still has pricing power potential. Management is taking clear corrective actions. Bottom line, Lululemon is transitioning from growth at any cost to disciplined premium brand execution. That transition creates short-term pain per long-term potential. I remain constructive as the current actions, if executed well, should lead to stronger margins and a healthier brand over time. Okay, guys. So by and large, it wasn't a fantastic quarter, but it wasn't that bad either. And I completely agree with how the market is reacting right now. The stock is flat, unchanged. Look at that. It was about 2% lower at the time I started recording this video. Now it's only down 1.47%. This is nothing. And again, it's because of the fact that the company, they were expecting worse. All right, let's put it that way. It's not good to see that margins are coming under pressure. Again, the company is facing pressure from tariffs. Tariffs are leaving a dent in the company's profitability, and also the removal of de minimis exemptions, which allowed the company for a very long period of time to actually sell products under X amount at no costs. Okay, but now they have to pay fees, right? Which is, of course, hurting profits. And if I show you right here, you can see that. Let's flip this to the trailing 12 months. Take a look at this decline right here in margins. Look at this. This is operating margin taking declining, and you can see that operating margin is also declining, and the same goes for the profit margin. But even though they are declining, and this is essential, you have to put that into the broader context. These pains are not unique to Lululemon. If you look at the broader sector, companies like Adidas, Nike, Deckers, right? They are all struggling because this is not just a company specific struggle, it's actually a macro headwind. Because as you guys know, they are part of they are part of the consumer discretionary sector, and consumers when they are facing struggles from an economic standpoint, they will cut down on spending. And the first things that they will cut down on are discretionary items. And that includes these brands and this sector. So Lululemon, Nike, whatever. So we have to always analyze this taking the broader view of the sector in which they operate. Okay, so that said, the Lululemon continues to have some of the wealthiest margins in its sector, which is why I like that. I like the fact that they can absorb a lot of that pain initially, right? Because their margins allow them to do that, while many other companies will actually face a lot more pain. And we are seeing that, for example, with Nike. I mean, Nike, you compare Nike's financials with Lululemon's, and I think Nike is facing a lot more pain, if you guys ask me. And that is, I saw that, right? And that's part of the reason why I chose Lululemon over Nike. So in fact, let me flip this to Nike so you guys can see what I mean. Take a look at that. I mean, look at these margins. Okay, take a look at this. The profit margin at 5.43%. Look at the staggering decline. Same. Look at gross margin. Look at operating margin. Their margins are just collapsing at a significant pace, and because they were not that higher, right? Before any of these tariffs started, they are now facing significant headwinds. Okay, so Lululemon is definitely not in the same position, and I think the turnaround for Lululemon is going to be faster than that of Nike. Not least because Nike is priced at a much higher premium compared to Lululemon, even though the fundamentals are worse. I mean, that doesn't make sense to me. Even though Nike has a wider moat than Lulu, I mean, price is what you pay, value is what you get. To me, this doesn't justify this premium to us for a company that is actually declining. Lululemon is not declining. Let me make that clear. If I show you here, for example, the trailing 12-month revenues, you can see that revenues are declining, which means that the business is shrinking. If I flip this to Lululemon, that is in stark contrast to Lululemon's performance. Revenues are growing, not declining. And yet, if you look at the multiples, Lululemon is priced at a much lower multiple compared to Nike. I mean, it doesn't make any sense to me. But again, I like the dichotomy between stronger fundamentals and lower valuation. I think this will bode very well for me from an investment standpoint. Okay, guys, if you like this video, make sure you smash the like button, and thank you so much once again for everything.